Well, welcome back, ladies and gentlemen, to our second major area of fundamental concepts pertaining to the field of finance, having to do with the concept of risk and return. In concert with time value money, I would argue equally as important and equally as foundational to our particular field, because as you'll soon learn, and you probably already understand, we hear the concept all the time, nothing ventured, nothing gained, risk and reward. Those sorts of concepts play out in practical terms in our particular field. So this particular set of slides is really dedicated to understanding this concept and how it really plays out in the field of finance, how we value that, how we include that in some of our analyses. And then, of course, we'll revisit this at a couple different points throughout the course of the semester as we see how risk is applied in a particular context. So first and foremost, what is risk? Well, risk really is whenever there's the potential to return less than what is the amount expected on any particular project, any particular investment, what have you. Of course, nobody argues when you earn more than what was expected. It's always the threat that we're not going to make out the way that we thought we were going to make out. Okay, so obviously the greater the probability of a return far below what's anticipated, the greater the perceived risk. And once again, risk factors are a primary driver of expected returns in financial markets. Okay, and we see this, and from a practical standpoint, as a simple concept as a FICO score. Okay, why you have a credit rating as an individual. Basically, that's the credit markets determining how good a payer you are, how consistent you are, what your earning potential, all of those factors considered. How long have you been in the present position? What sort of field are you in? All are factored in, as well as issues of how many different loans do you have outstanding? What do you have going on in terms of your entire debt burden? All are factored into a FICO score, which then, of course, your credit rating houses, sell or produce to any lender, whether you're going for a mortgage, or a new car, whatever the case may be, and you encounter it as part of your interest rate that you have to pay on any sort of debt instrument. Okay, so of course that applies at the personal level, but equally applies at the organizational level, and we'll talk about how that manifests, especially as we start talking about debt financing at a later portion in the course. Okay, so part of this too, when we start looking from an organizational standpoint, is, and we start to use this from a practical standpoint in finance by understanding how wide a particular investment or project, how wide a distribution we expect to see. Now, in this particular case, we have an expected rate of return on a project or an investment of 15%. Okay, for both of these investments on this particular slide, investment X and investment Y, they both are expected to return 15% based on all the forecasts and all the modeling that we've done. Both land on 15. But where we start to apply our good friend statistics in the field of finance is understanding what sort of distribution of returns that we might expect to see. Okay, in this case we have investment X with the higher peak, much tighter distribution around our expected rate of return, and here we have investment Y, okay, where we actually have the same expected rate of return, but a much wider expected set of distribution for the expected rate of return. Okay, which investment is riskier? Well, most people, okay, and this is what we'll talk about on the next slide, most people are risk averse. With investment X, okay, we have expected rate of return, much tighter distribution, very small probability that we are going to lose money, okay, or come out with a expected rate of return less than 0. With investment Y, with a much wider distribution, it's still not huge, but certainly much more than we see with investment X. So as a result, most people would say that we have riskier investment with the wider distribution of investment Y. Okay, now that's most people. You will find in organizations, and you'll find them on an individual basis as well, that we are also potentially giving up all of this distribution over here as part of our calculus in determining which investment to go with, assuming they're mutually exclusive. Okay, but most folks are going to be, like I said before, risk averse, meaning that higher risk investments require higher rates of return. And this is really the foundational concept of how the financial markets are structured. Okay, even though we might find risk neutral and risk averse people, or risk neutral and risk seeking people, most of us tend to be in the middle of this, okay, where we find our own level of comfort with regards to risk, okay. And because of that, again, our financial markets are heavily dependent on this concept that higher risk investments require higher rates of return. This is why the lower my FICO score goes, okay, the more I default on loans, or I pay late or whatever, I'm determined to be higher risk. As a result, the next time I go and try to get a car loan, I'm going to end up paying a higher rate of return. Okay? Very fundamental concept, but very important to the field of finance. Okay? And again, we leverage our good friend statistics to help us understand how risky a particular investment might be. Okay? And of course, you've all had statistics, I'm assuming, at some point in your past. We talk about that distribution really in terms of probability. Okay? So another concept we have to understand is we have the thought of an expected rate of return. So as we look forward in time, and it's something that I really didn't mention, at least in the first video, with regards to time value money. A large departure, or a significant departure from between the fields of accounting and the fields of finance is accounting is all historical. Okay, it's kind of like a historian looking at exactly what happened, recording facts and figures to be able to substantiate what has happened over the last quarter, the last year, what have you. Finance is really looking forward. Okay, we certainly can leverage accounting data and accounting information, annual report data, what have you, but we will take that information then and start to try to look over the horizon, so to speak, or around the corner, whatever analogy you want to use. Because of that, of course, we then have to look into this realm of risk and understand that we are expecting, based on all particular inputs that I've, in our best guesses or our best estimates, right? Because of this is where the risk factors come in. My expected rate of return might be substantively different, sometimes incredibly substantively different from my realized rate of return. Okay? And again, when that departure occurs, that's where we consider risk to be present. Okay? So just to walk through an example, here we have kind of understanding expected and realized rates of return. We've set up basically an analysis and tried to figure out, based on our best guesses at a various economic states of the economy, what the probability of occurrence is going to be, and then based on this economic state, what is our rate of return going to be. So this, if you look at it, this is just basically a bell curve. Very little chance of a very poor, as well as very little chance of a very good economic state. Most likely we're going to be about average. That's about 40% of the distribution. But at each one of these stratified levels, we have a specific rate of return. In this case, in this case, the very poor side of things, try not to grab it here. That very poor, if I look all the way across here, we can see that my MRI is going to net me a negative 10%, and the clinic is going to lose 20%. Again, assuming that these two projects are mutually exclusive. Okay? So if I wanted to come up with an expected rate of return, okay, in this case I'm going to look at the expected rate of return on the MRI project. I have my probability, and again, if you look back here, hopefully you can see it still over on the left-hand side. I have a 10% probability. That's 10%. That I'm going to lose 10%. Okay, that's my 10% here at the top of the chart. Plus a 20% probability that I'm going to earn 0. That's my second strata here, okay? So on and so forth until I come up with my expected rate of return on my MRI project of 10%, okay? Which stands to reason given that 40% of my distribution, and it's equally distributed around 10%. So that's not unusual, okay? Now, as we move forward, we also have to understand this concept of standalone risk, basically defined and measured as an individual project or an individual investment is held in isolation, okay? And we determine that standalone risk through our good friend sigma, okay? That should be very familiar to most of you that have taken statistics. Sigma is our standard deviation of the return distribution. Okay, so how do we find that standard deviation? Okay, well, as you all remember, standard deviation is just the square root of our variance. Okay, we find the variance basically again with my probability, again my 10%. And we're looking all the way back. Here's my 10% times my rate of return my rate of return at that particular threshold. Here's my -10 minus my expected rate of return overall. Which again, this goes back to this 10% expected rate of return squared. Okay, I add up each one of those strata and I come up with this fabulous number of 120. Well, what does 120 mean? Well, nothing. Okay, it only becomes relevant when we take the square root of it to get 11%. Okay, well, what does 11% mean? Well, in truthfulness, it means nothing as well until we compare it with doing the same calculation and finding the standard deviation for my clinic option on the second column here. When I do all that, I find out that my clinic actually has a standard deviation of 18%. Now I have, on an isolated basis, I can say that my MRI clinic is less risky because my standard deviation isn't as high as what it is on the clinic. Okay? And graphically, we can look at it this way. Notice I have a slightly higher expected rate of return with my clinic than I did with the MRI. But as you can understand through the standard deviation calculation, my distribution, however I've graphed this out, I mean this might be a little bit exaggerated for presentation purposes, but my standard deviation for my clinic is higher at 18% than what it is for my MRI. Okay, so of course this means larger standard deviation indicates more standalone risk, but ultimately it helps us to understand, at least on a fundamental basis, which one of these options is the riskier option to pursue. Okay, now which of these projects would you consider to be the one that you would want to fund, if assuming that they were mutually exclusive or standalone? Okay, well, that is going to depend on your organization, and it's going to depend on the individuals in the C-suite team or on the C-suite team, on the board, whoever's making the decision. Okay, many, frankly, would choose the MRI option. 10%, much lower potential for loss, but you will find folks in an organization that will want to seek this higher return and understanding that they're putting this at risk in order to potentially get all this upside return. Okay, but at least now from a decision-making standpoint, we can move forward and say, okay, this is what I think is going to happen. Okay, so again, mutually exclusive, just in a chart basis here, which one would you choose? Most I would argue would choose the MRI, but certainly not the only potential alternative out there. Now, how is this risk played out when we start looking at the risk versus return sort of relationship? Well, if we look across from 1925 up to about 2009, so it's a little bit dated here, but we can see how this actually plays out in the financial markets. Okay, and here this red line is our small stock portfolio, where if we invested $100 back in 1925, if we were sitting at 2009, we would look at basically a $7.3 million valuation. Okay, and you can even start to see a little bit of the financial crisis as it hit in 2008, 2009, and what sort of correction that was. Okay, Likewise, if we look at simple consumer price index, or the basic measurement of inflation, $100 basically is turns into $11.74, and then all of these different investment classes in between. Okay, now this is all well and good. Of course, everyone's lamenting the fact why they didn't have grandparents that were willing to put $100 into a small stock portfolio back in 1925. We'd all be rich and we wouldn't have to be worrying about this class. But we also have to recognize that with reward comes a vast amount or a certain amount of risk. Okay, so if we take this same distribution from slide 13, we kind of categorize it in bins with regards to the returns that happened within each one of those years from 1925 or 1926 up through 2008. We can see the distribution as it occurs and how much risk is involved with each one of these particular investment classes. Here we have 3-month treasury bills. Notice we come up from the zero bin, right? We come all the way up here. We've got a lot, of course, that are very close to zero, very tight distribution, all the way down here to our small stock portfolio. Again, here my zero bin, and look at the distribution as we see across all the years between 26 and 2008. How many years were we losing our shirts, as well as how many years where from a small stock portfolio where we're really gaining a lot. This distribution, although it plays out depending on when you enter and exit this particular market, is certainly tells a story in terms of the conceptualization and the connection between risk and return. So as we look historically across these, basically 4 broad asset classes: small stocks, large stocks, government bonds, and treasury bills, you can see our historical return as we go, as well as our standard deviation. Each one of those kind of a gee whiz slide, but helps to illustrate the point of those small stocks. Yes, they net us a better return, but we do so by onboarding a significant more amount of risk. Okay, and depending on where you are in the age scale, between basically 18 and whatever natural death, you may not be willing to onboard this amount of risk and might actually favor a large stock or even a bond portfolio that can assure you some degree of return with a much more defined or minimalistic set of standard deviations. Okay, now we also have to understand this concept that we don't typically pursue investments in isolation. Okay, we typically are invested in things across a portfolio. This is true even at the organizational level. Certainly should be true at the individual level, and we can take lessons from those folks that work for Enron and were forced to invest all of their 401k dollars back into the company. Of course, when Enron went belly up, so did all of their retirement portfolio. But we also have to understand the nuances of not only we want to diversify our investment vehicles, we also want to talk about what that does in terms of risk. So to illustrate this point, again, we have the same basic setup as what we had before, with the probability of a given economic outcome, and we have 4 individual investments that then we're trying to, or what we've done is done a 50-50 or equally weighted portfolio between A and B. That's between these two, A and C, and A and D. And of course, we could come up with versions that are going to look different than this. We could combine B and C and D and so forth. But for illustration purposes, we just did A and B, A and C, and A and D. Okay. Now notice here's my expected returns across the top line here, and we have our standard deviation as well. And as we combine these portfolios, and again, this is for illustrative purposes only, we can see in the case of A and B, we've got a 10% expected rate of return with 0 risk. Now, I'll say right now, if anyone finds this particular investment alternative, please write down my email and my telephone. Please give me a call right away. Any chance that I can get to earn 10% with 0 risk, I want to know about it. Okay, but again, for illustrative purposes, we've combined A and B here, and you can understand as you look back at these individual returns how that occurs, because they're frankly just mirror images of one another. Okay, just in inverse. Then of course AC and AD, slightly different sort of risk mitigation, and you can understand how then the standard deviation can play into that. So again, as we look at the portfolio return, the weighted average of the components' expected returns, we have the AB, the AC, and the AD, and we have to understand then, based on what we see, is portfolio risk is not simply the weighted average of the returns of the components. We actually have to look at the relationships of the returns, okay? And we start to use that magic word when we start talking about statistics. Relationships, of course, comes to our good friend correlation from statistics, okay? And correlation, if you recall, is measured by the coefficient R, okay, where we have perfect positive correlation, which we could look back at portfolio AC and say that's not perfect positively, but positively correlated. We have perfect negative correlation, which we illustrated in portfolio AB, and then we have zero. Basically, there's no connection between the two different investments. Okay. So, what does that mean to us? Well, when we start looking at the real world, it's rare, of course, if not impossible, to find a perfectly positive or perfectly negatively, or even a completely unrelated, basically two sets of assets or more. Okay, correlation between two randomly chosen investments is likely to range somewhere between about 0.4 to 0.8 on the positive side. Okay. And as we look some actual correlations based on historical data, of course, S&P 500 largest market cap companies. If we compare it to itself, of course, the correlation is 1. If we look at S&P or the 500 against domestic small stocks, historically about 0.79, all the way down through gold stocks, which of course is typically the safe haven for when we're things are going a little bit haywire in the markets. People typically flee to gold, and that correlation, even as basically a safe haven investment, is still at about 0.3. So as we add additional investments to a portfolio, my standard deviation of my portfolio decreases. Okay. However, as I add them, the incremental risk reduction decreases as more assets are added. So why would that be? Well, what we're really illustrating here or trying to say is, well, if I've got one stock down here, I've got a standard deviation, I'm just pulling a number out of the air here with 35%, but that one stock has the potential to vary quite widely around some expected rate of return, 15%, again, pulled out of the air. As I add more stocks, and I'm looking strictly at equity instruments at this point, as I add more, my distribution tightens, assuming they are randomly selected, which is a broad assumption. Okay. As I add more, my distribution gets tighter and tighter, and here I've got many stocks, define many however you want, 25, 30. Okay, but my standard deviation is still upwards of 18%. Is it ever possible to actually squeeze this distribution until it's right around 15%? Okay, and the answer really to that is no. It's pretty difficult to do. And the reason for that is in our markets, both equity market, bond market, real estate market, there is a certain amount of what's called systematic risk, as well as unsystematic risk. Okay, systematic being the variability of returns on stocks portfolios associated with change in return of the market as a whole. Unsystematic is the variability of returns on any sort of instrument, not explained. It's basically avoidable through diversification. Okay, so from a chart basis, we talk about unsystematic risk, the factors unique to a particular company or industry. Here I have the example of a death of a key executive, loss of a government defense contract, an election, for example, might change things. Okay, versus systematic risk, changes in the economy, tax reform by Congress, change, and you could even argue the election might have implications here as well. But systematic things that aren't inherently embedded within the company in particular. Okay, so because of that, as we add more securities to our portfolio, right, we'll get down to a point where we've minimized our unsystematic risk, but we have a hard time ever changing our systematic levels of risk. Okay? So, because of this, or at least partially because of this, one of the the issues, we always want to try to diversify, and depending on the individual in question, depending on the perhaps the organization, if that's the investor in mind, we're always going to try to diversify to not put our eggs in one basket. Okay, but we also want to understand how much risk we're onboarding with each particular investment. And the easiest way to understand what this might shape up or how this might be measured is through what we talk about from the equity side of the house, or the stock market. Stock investment is the term beta. Okay, and beta is essentially just a measure of how volatile a particular equity investment is when compared with in general, it's compared against the Standard & Poor 500 index as a whole. Okay, so if a beta is equal to 1, it's said that the investment has average risk, where the average is defined as the riskiness of the portfolio. Okay, or in our case, like I just said, the S&P 500. If the beta is greater than 1, the investment has what's considered to be above average risk, which means it's simply more volatile, with basically large swings in pricing from day to day, week to week, month to month. And a beta less than 1 is below average risk, meaning that we don't see quite the volatility as what we'd see in the portfolio as a whole. Most of our investments have betas in the range of about 0.5 to 1.5. Okay, and depending, if we look back to some of these concepts, the unsystematic and systematic risk, our betas will typically capture or mirror some of what's happening on both the unsystematic and systematic sides. Okay, so the higher the beta, the more exposure we have to both systematic and unsystematic risk. Okay, and that gets priced into the stock market. We of course have millions of investors that are recognizing when those risk factors play out, and of course that swings the stock market price sometimes quite wildly. Okay, so just from a context standpoint, you can understand how this beta plays out just by knowing some of the companies on this list. Here, right around 1, we have Microsoft and Starbucks. Okay, and the risk factors involved here are pretty consistent from a historical standpoint of basically the market as a whole. But as you look up this stream, Family Dollar stores here, we have the top has an equity beta of 0.1. For those that don't know, Family Dollar, if you go out into any West Texas or fairly decently sized West Texas community, rural communities in general, you'll often will find a Family Dollar store before you will find a Walmart. Okay, Family Dollar has a very large store count. They are, again, almost ubiquitous in the rural markets, and really are the Walmart stores or easy access stores. Whereas larger communities will tend to find the Walmarts that will come in. Okay, because of that, because they offer staple products. There's a steady series of cash flow streams. They're not terribly exciting from an investment standpoint, but they have an equity beta then as a result of very, very low 0.10. Okay. Now, if I go to the other extreme, we have companies like Salesforce.com, Autodesk, Sotheby's, Auction Services, eBay, Amazon. Okay, and of course, these betas change and they fluctuate from time period to time period, year to year. Okay, but you can understand that when you start talking about luxury good producers like Coach, Tiffany & Co., or even companies that might be struggling a little bit to compete with companies like Amazon, as we have with Sears, we might see a higher equity beta, where basically the market is pricing in some of the risk that's occurring by virtue of what's happening over here with systematic and unsystematic factors. Okay, now how this becomes useful. This beta, in terms of just, okay, it's good, I understand what a beta is, we can actually use that beta term in concert with a few other inputs to understand what my required rate of return or an expected rate of return on a particular equity investment might be over the course of the next year or so. Okay, so that required rate of return on equity can be coupled with our risk-free rate, okay, and our required rate of return on the market, coupled with my beta to end up with my required rate of return on an equity. Okay, so where do I get this rate? Well, the risk-free rate is typically associated with your treasury returns. So what's our actual basically risk-free pricing on a treasury instrument these days? And depending on the time frame involved, we can look at basically at a 3-month to a year treasury. Okay, fairly nominal rate. And we consider our treasuries to be risk-free because up to this point so far, the United States government has not defaulted on any loans or any of its bonds. Therefore, it's considered to be risk-free, and we earn a fairly minimal, although more than zero, return on that risk-free instrument. Our market risk premium, okay, which is basically the difference between my market or my required rate of return on the market and my risk-free, is often given by some of your trading houses expected return over the course of the next 2 to 3 years. We could also look back historically, if we recall back to our earlier conversations with regards to returns over time. We can look back to this chart and say, okay, my return over here for this particular type of instrument, we can talk a large stock portfolio, 9 point whatever percent, I can barely read it, minus my risk-free rate. That should be able to give me a good indicator of my market risk premium above and beyond my risk-free rate. Okay, I multiply this by my beta, and now suddenly I add it to my risk-free rate baseline, and now I have an expected rate of return on that particular investment. Now, we're going to come back to this later, but I want to introduce the concept to help you understand how we can actually use some key inputs as well as a risk profile to better understand how basically risk can be priced into an equity investment, at least as an example. Okay. Now that CAPM, or the capital asset pricing model, has a few assumptions that are listed here. Basically, and all models are useful to a certain degree, but these are some of the predicating assumptions that we have to at least consider. So, as an example, assuming my economy has a 60% chance of the market returning 15% next year and a 40% chance the market will return 5% next year, if I have a risk-free rate of 6% and a beta on Microsoft of 1.18, what's my expected return? Well, some quick math based on the formula I just showed you. Here's my expected rate of return on the market, 60-40 split, come up with 11%. We can maybe avoid this even, by virtue of just looking back historically. But of course that has it's all based on whatever data we want to use. But I can substitute this 11% into my capital asset pricing model formula. Here's my 11% minus 6% for my risk-free rate. That's my market risk premium, multiplied by my beta on Microsoft, 1.18, added to my risk-free rate, and now suddenly I have an expected rate of return on Microsoft based on current market conditions of 11.9%. Okay, so it is a tool, and you'll see as we get into the weighted average cost of capital, we start talking about equity financing and kind of how we and why we want to value things from a organizational standpoint. It's a tool that will revisit and help us to help shape at least the equity component of our weighted average cost of capital. Introduce it here so you understand how it's based on risk. Now, another factor we want to talk about is this concept of the interest rate. And again, how interest rates are tied to risk factors. And we can see this as we look at different interest rates that are charged to different organizations. Okay, and you can understand if you just really think about the markets that each one of these organizations serves. You can understand the type of whether it's a a fundamental staple provider or more of a luxury provider, you can understand how risk is actually baked into each one of the interest rates for each one of these organizations. So, of course, U.S. government Treasury notes, 2%, not too far off from where we are at present day, in fact. Walmart, of course, love it or hate it, Walmart is a provider of staple products. They do well both in economic upturns as well as economic downturns. Coca-Cola, right or wrong, Americans like their soft drinks and are, will, no matter whether it's a good year or bad year, they'll consume a lot of Coke products. Disney, as we go up this chain, then we start to see increasingly luxury item-esque sort of thinking as we start talking about the cash flow streams that are available to these firms. Walt Disney, ubiquitous in terms of the exposure with regards to movies, which of course is one of the staples and its cash flow streams, but also the theme parks, which of course have a significant cost structure to it. Okay, Safeway stores, FedEx, and last but not least we have GE Capital, which is more speculative in terms of basically a capital provider, especially in the healthcare industry and many others, provides access to funds, not of which are all repaid, of course, which is why it carries such a larger percentage interest rate on any funds that it borrows. Okay, and as I mentioned early on, that interest rate in the market is how capital is priced. 4 primary factors that influence it. Other investment opportunities, so I don't have to lend you funds if I've got a better opportunity someplace else, or if I want to consume those funds, my time preferences for consumption. Of course, risk, and last but not least, inflation. Okay, so that interest rate are also influenced by what's going on with the Fed. Okay, and I don't want to get too far down in the rabbit hole of economics here and economic policy and budgetary policy, but each one of these major bullet items basically can influence what's going on with interest rates. The Fed, of course, as the Fed changes its its short-term federal funds rate, becomes one of the fundamental drivers behind what we see with the risk-free rate. Budgetary policy, as Congress fails to pass a budget or cannot reconcile, cannot balance the budget, and that financing basically that we've come to just know as part of living in America, $19 trillion and counting. Okay, that influences interest rates as well, because of course budgetary policy, if interest rates go up, our servicing on that debt that we've accrued becomes a larger and larger portion of our discretionary financing, which of course has implications then on taxes and so on and so forth. And lastly, again, right or wrong, it can be argued that our government in particular and many governments around the world really follow what's called Keynesian economics, where our gross domestic product is considered to be a function of consumption, large systematic investment, government spending, and then the difference between exports and imports. Okay, so you can explain a lot about what happens at the governmental level and how that might eventually influence interest rates by what is going on with each one of these large segments. So big government spending, this is where we get cash for clunkers and basically huge infusions of cash with regards to growing a defense budget, for example. However, biggest component of our entire gross domestic product is in the consumption side of things. And roughly about 65 to 70% of our gross domestic product here in the country. Because of that, you'll see how interest rates can have a significant impact on growth or decline of gross domestic product. Okay, again, that's all I'm going to say about economics, but certainly 3 significant factors that play. Now, one place where we actually see this interplay, and we start talking about the interplay between interest rate determination and effects on the economy, is through what's called the yield curve. And you can open up any Wall Street Journal, you can Google it right now, current yield curve. You can look, the St. Louis Fed, I believe, publishes the data showing it, basically over time and what it looks like. The yield curve basically is how we have this time structure to interest rates. And really what we're looking at here is, in a normal yield curve situation, you have a term, okay, here in years, where in short-term loans, right, should bear a lower interest rate for various reasons. One, we're not locking the money up for a long period of time. We've got other investments, that we could perhaps pursue. I mean, all the litany of issues that I talked about up here under the cost of money really plays out in practical terms through this term structure of interest rates and the yield curve. Okay, this is a normal yield curve. And if you open up, as of today, this is May 26th. If you open up the yield curve in basically section B in the money investing section of the Wall Street Journal, this is what it looks like. And then it will also give you a comparison of what it looked like a year ago. And a year ago, it was under the curve of what it is now. Okay, so that's a normal yield curve. In some instances, the yield curve can look more like this, or even like this, where this is actually a negative, or upside down yield curve. And if you think about this from a practical standpoint, notice what's happening short term here. We've got a higher interest rate that is expected to go lower over the next 2 to 4 years. Okay, so what would happen from a consumer standpoint? Now remember what I said. Gross domestic product over here is a function of largely consumption. So what's going to happen when we start talking about economic output? Okay, if I can wait a little bit before I buy my new car, I can wait a little bit before I buy that new house, because I'm going to pay less in terms of a monthly mortgage payment because my interest rate is likely to be lower. Well, it has a very chilling effect on the economy, gross domestic product, right? We start to see real slowdown, stagnation of the economy as a whole. Okay, so I offer this because this is a tool to put into your, basically your files, into your memory banks, because as you start to make decisions for your organization, and I went so far as to include this in the presentation just for this reason. This is an incredible tool to just tuck away, because that negative yield curve that I just talked about is an incredible indicator of things to come, okay? And an indicator that we are going to have a recession, or certainly a slowdown in the economy as a whole, okay? In fact, as you look, in your textbook and or here on the screen, any point that we have this inverted or negative yield curve, you can see it's marked in red, okay? And the gray shaded areas are all your points at which you have a recession of varying durations, right? So let's say you're about to make a major investment in your organization. You open up the Wall Street Journal and you see a curve that looks like this, okay? Great indicator that you might want to think twice before you decide to push forward, okay? Because you might expend a whole lot of capital and not have real good basically returns on that capital based on the state of the economy, okay? Because we have the historical record to be able to show that that inverted yield curve really is a great indicator that something's around the bend and we're going to enter into a recession. So just a tool for your consideration. Now, last but not least, for this particular slide deck, interest rates. How are interest rates actually developed? What's involved with them? What's included? Well, interest rates really are, again, our base rate plus one or more components to compensate for inflation and risk. So here's the model for, a typical model for what an interest rate buildup looks like. And, basically in full terms, which, as you look over here to the left-hand side, my real risk-free rate, again, this is my treasury instruments. Here's the IP is my inflation premium, what I expect inflation to be. Default risk premium, this is how credible am I as an organization or as an individual. My liquidity premium, how much does this tie up liquidity? How much are we talking about? my price risk premium. How does this, basically compare to other priced instruments within the market? And lastly, this becomes important. We start looking at debt financing. Is my call risk premium? Is this bond, for example, going to or potentially can be called back, by the organization? In which case, I'll be out of the money, so to speak. Okay, so all the interest rate components. I encourage you to drill down into Investopedia. I don't want to really belabor the point here, but great link in terms of explaining what all those interest rate components are. Now, how that links into our time value money calculations, that annual percentage rate that we always hear, that interest rate, you typically hear quoted on various ads and credit card advertisements, whatnot, might not be, and typically is not, the actual rate that you are paying on that particular credit instrument or credit card or whatever bill, whatever the case may be. Okay, so much so that we have to say the annual percentage rate itself cannot be used as a discount rate unless you only have one compounding period per year. Okay, if you only have one per year, then APR is the same as the discount rate, and we can march forward from there. Okay, if it's not, okay, then we have to consider what's called the effective annual rate, the total amount of interest that will be earned at the end of a year where there is intra-year compounding. Okay, and typically what we see is that annual percentage rate is less than effective annual rate. Okay, so a little bit of, and as you become a little bit more savvy with what you're hearing on the radio or on TV or wherever you see, this, basically these financial instruments and credit cards advertised, for example. That's my typical example. It's, just listen very closely and understand why they want to advertise the annual percentage rate versus my effective annual rate. Okay, because the APR is actually typically less than the effective annual rate, and they're not necessarily always disclosing the compounding periods in any given period of time. So how do we actually calculate effective annual rate? Well, my annual percentage rate divided by the number of compounding periods, 2 raised to that same number minus 1. So if I've got, for example, a 5% basically APR, I can actually go through the mathematics and come up, 10% APR here, that's the 10%. I've divided it by 2, that's my 0.05, raised to the second power. I end up with an effective annual rate of 10.25%, which of course is much higher than my APR or my stated rate. Okay, so we can of course look at it annually, my 10%, quarterly, monthly, daily. Okay, and you notice the changes that the effective annual rate takes as you look at multiple compounding periods. And we can actually leverage Excel to this effect with the effect formula, which we put in our nominal rate and the number of periods per year. So here my equal effect 10% quarterly ends up being my 10.3813, which of course is my 10.38 that we saw here on slide 49. Now, how do I use this? Well, if I've got payments occurring annually, compounding occurring semi-annually, we can't use the normal annuity valuation techniques unless we adjust for the effective annual rate. So we find that effective annual rate based on the stated implication here of I've got semi-annual compounding on an annuity. Okay, I change my discount rate then from 10 to 10.25. I enter it into my future value formula, and then I do everything else the same, and we end up with $331.80, and the crowd goes wild. Okay, so I know that was quick, down and dirty about a lot of stuff with regards to financial risk and return. Of course, this is probably one of the more complicated portions of the course. Take your time with it. I'm certainly available to answer questions as need be, because we start to walk and talk through some of the kind of the more intricate calculations with regards to figuring out variance, standard deviation, and whatnot. But what we'll try to do from here, this is probably the most complicated section of the course. We'll try to draw from here is make it more contextual and a little bit basically practical with regards to how we actually leverage this information for organizational decision making. So with that, once again, thanks for your attention. Good luck, and we'll talk to you soon.